This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Dirty balcony? Clear Edge professionally cleans decks and balconies. Zero mess and no water runoff. Book today and see the difference.
This is the Victoria Real Estate Podcast. Welcome to the Victoria Real Estate Podcast, where we discuss everything Victoria real estate. I'm Adrian Maclaren, and I'm joined by my co-host, Vincent Baart, and we are realtors on the City Nest team at Remax Mimosa in Oak Bay in Victoria. Today's episode is a big one. We are joined by Vincent Smith, founder and CEO of Smith Manoeuvre Services Corp, and the man caring for one of the most powerful financial strategies in Canada, the Smith Manoeuvre. He's also the best-selling author of Master Your Mortgage or Financial Freedom, and a sought-after speaker who makes complex financial ideas simple and actionable. So, Rob, thanks for joining us today.
It's a pleasure. Thanks for having me.
Yeah. I'm really excited about the podcast. I actually have been a fan of the Smith Manoeuvre for a long time. So when you had originally reached out, I was like, oh my God, this is fake. I was like, this can't be real. This is incredible.
My name is actually Tim.
There we go. I knew it was too good to be true. But yeah, very excited. You know, I learned to the Smith Manoeuvre kind of like right out of, right when I was getting into college and kind of started paying a bit more attention to financial literacy. And I think Vince is the same.
Yeah.
And so I've been big fans and I learned about it a long time ago. So yeah, very excited to have you on the podcast today. Now, before we get started, obviously we kind of know about the Smith Manoeuvre and everything that you're about, but for our listeners, can you give a bit of a personal summary background about yourself?
Sure. Yeah. I did my university degree here in Victoria, went to UVic. That was after moving over from Vancouver so I could escape my parents and get into university.
Nice.
Yeah. I spent a lot of time in Victoria here. I got a scholarship to go to China. I studied Mandarin in Shanghai for a while and was there and back over a period of about 8 years. Lived in China and worked. And one day in 2003, my dad said, your mom misses you and you need to come back. So I did. So I came back to Victoria and I started working alongside my dad. That was back in 2003. And I was an investment advisor for 12 years before I sold my business so that I could get the word out about the Smith Manoeuvre Canadians a little more broadly. I was restricted as an investment advisor with the compliance regime. So I wanted to write a book and get that out there, which I did. And now full steam ahead.
Cool. For those who, I guess, haven't heard it before, what exactly is the Smith Manoeuvre?
So my father back in the mid-'80s, he was a realtor and he became a financial consultant. And he wanted a bit of a niche for himself. And he looked around and said, what is the problem that a lot of Canadians face? And the problem was that we have non-deductible mortgages in Canada. And he contrasted that with the Americans who are able to deduct a good portion of their mortgage. And well, he thought that wasn't very fair. So he set about to solve that challenge. And he looked at investing, he looked at mortgages, he read the Tax Act, which is a very large,
good on him.
very large and fascinating document. And yeah, basically he just took a bunch of pieces of different puzzles and put them together into the strategy, which allows Canadians to pay off that expensive non-deductible mortgage debt much sooner than otherwise, to reduce their tax bill significantly, and also to start investing right away rather than what a lot of Canadians are pretty much forced to do, which is first pay off your mortgage and then invest for your future.
Right.
The reason that is because there's limited resources. And if you only have so much money, you got to make your mortgage payment. Right. Nobody cares if you don't invest, but they certainly do care if you don't make your mortgage payments. So.
Yeah. Okay. Now you have kind of taken your father's idea, I think it's really, really cool, and now kind of relaunched and modernized the strategy for today's realities. What made you decide to kind of carry on and kind of expand on his mission?
Well, when I came back to work alongside him in 2003, up until that point, I didn't really know what he did. I was a young kid and I was out on my own. I was living in China and having a good time over there. I came back and finally really learned what he was doing for Canadians. And it having been outside of the country for a long period of time, I didn't really know what it was like in Canada at that point in time for Canadians. And the longer I was working alongside them, the more challenges I saw the Canadians were facing. And I knew that, this was the strategy that he had developed back in the mid-'80s was something that was truly helping Canadians who were falling further and further behind. And that hasn't changed with the way taxes are going, cost of housing, the inability to save for our future. So the longer I was an investment advisor, the more challenges I saw Canadians face.
Mm-hmm.
And that's the primary reason why I sold my investment advisory back in 2018, because I had over 500 families as clients, helping them implement the strategy, but I was helping them one family at a time. And I thought that if I had the freedom, the latitude to write a book, get it out to every Canadian, then more people would hear about this strategy and be able to make up their own minds if they want to pursue it in order to improve their financial situation. And, it's not for everybody, but it is for a large portion of the population.
Yeah. And who obviously when you say large population, is there like a target market, or is there somebody who you see that the Smith Manoeuvre is kind of perfect for?
Well, I always say if you have a mortgage, you have bad debt.
Yeah.
If you have bad debt, you need to get rid of it.
Mm-hmm.
Just to clarify, that's mortgage on a personal residence.
That is correct.
Okay.
Yeah. Now, when we're talking about investment real estate, we're talking about a different type of mortgage, if you will, when we're talking about deductibility, because it is tax deductible, but our principal residence, it's not.
Mm-hmm.
So anyone with a mortgage is potentially suited for this strategy. Obviously, when it comes to investing and creating wealth, the sooner you start, the better off you're going to be at the end of the day. But when I was an advisor, we had clients who came to us, they were in their 60s and 70s because they had mortgage debt. And they knew that if they were able to convert that from bad debt to good debt, they'd be able to improve their wealth, because necessarily if you're converting bad debt to good debt, you must be investing.
Mm-hmm.
And otherwise, for so many Canadians, it's just not possible with the limited resources that we touched on earlier.
Yeah. Okay.
Well, I'm really curious too. It's really fascinating. All of the talking points that kind of brought you back in 2003 and the things you were looking around there, I find that it's really easy for us to feel like we're in this sort of echo chamber today of everything that's going on politically. It's a very scary time to be even trying to build wealth in Canada. This isn't new, is it, Robinson?
No.
Like this is a 22-year-old story at this point.
It's been around since the mid-'80s.
Yeah.
40 years old.
And so even to go back to the mid-'80s when that story first started to come out with this, really cool idea, what was the scene back then? Was that around the really high interest rate scares and people were saying, well, this is really dumb. I've got high interest rates and I can't deduct any of it? Like, what was the impetus at the beginning?
Well, I don't know. I was about 7 or 8.
Yeah, sure. Yeah.
But, one of the things about I know we haven't discussed the Smith Manoeuvre and how it works, but one of the things that we see all the time is people saying, well, the Smith Manoeuvre doesn't work in low interest rates. And then some of the people will say it doesn't work in high interest rates.
I've heard that too.
And, we think about back in the 80s, what were rates at? They were double digits.
Yeah.
And if the strategy did not work in high interest rate environments, then we wouldn't be sitting here today.
Mm-hmm.
And that is the beauty of this strategy, is that I know we'll talk about the details of it a little bit more later on, but with the strategy, when rates are lower, you can invest more on a monthly basis. When rates are higher, you get a bigger tax refund. Your tax savings are larger, which means you have more to pay against your mortgage to get rid of it faster. So it's this seesaw where high rates, it works in all environments.
You're still winning. And yeah, it's a flexible solution. Yeah. Interesting.
Has there been any common misconceptions, or when maybe some people think this sounds too good to be true? How is that objection handled when you're talking to people?
Well, I mean, just like anything, I think if someone says it's too good to be true, you got to say, well, do research on it and learn about it. Luckily, what I had the opportunity to do is hand them a copy of my book and say, look, read this. It's a fantastic book. The author's just wonderful.
Great guy. Yeah.
But that's the first step. Once they read the book, or once they go to the website, or they do some reading and learning on it, then they will understand that what makes this work is debt.
Mm-hmm.
And the challenge that is faced by myself, by our Smith Manoeuvre certified professionals, a lot of the time is this concept of debt that Canadians have. they hear the word debt and they close their eyes and they just imagine this big, dark, ugly, ominous cloud above their head.
I'm doing that right now, actually.
Right? And then, that's a typical Canadian. But you go and ask a wealthy person, what do you think of debt? What do you think of debt? They're going to say, which type? Because I got two answers for you.
Yeah.
Right. So the whole too good to be true thing is simply a lack of understanding, which stems from the fact that I'm not going to go off on a tangent here, which stems on the fact that we don't learn anything in school about personal finance.
Yeah.
We learn from our friends and, or we learn from our parents, and they're not financial professionals in 99 out of 100 cases. So we have this misunderstanding of a number of different aspects of wealth and wealth creation, primarily debt. The wealthy use debt to their advantage. They do not avoid debt. They avoid the wrong type of debt, but they embrace the right type of debt.
Oh, that makes perfect sense.
Yeah.
Can we stop just skirting around the Smith Manoeuvre?
That's what I was about to say. Yeah. Okay.
Sorry, guys, more time.
Read the book.
Yeah. Yeah, let's do it. Can you walk us through kind of like a really simple to understand example of like how Smith Maneuver actually, I guess, transforms a mortgage into the wealth building tool?
Sure. So we're young. We get two jobs. We steal from our parents' coin jar in their bedroom, and then we also have to beg them for more in order to scramble together a down payment. We take that down payment, we go to the bank, we get a mortgage. Now, when we hear the word mortgage, we think, well, there's this one big chunk of debt that we're going to pay down over 25, 30, 40 years over the course of time. And that's what a lot of Canadians do. And all of this debt is not tax deductible. That's why mortgages are so expensive. So instead of having this one big chunk of debt, let's call it $800,000 mortgage, instead of paying that over the course of 25, 30 years, we simply need to get a different type of mortgage. There's a lot of different mortgages out there. There's a lot of mortgage lenders, but we need what's called a readvanceable mortgage. And they're not this mythical beast. I mean, all the big banks have one. They'll offer you a readvanceable mortgage. But what's important for everybody to know is not every readvanceable mortgage is the same. They all have different characteristics, which means the best mortgage for Maria is from this bank and the best one for John is that bank. But we need a readvanceable mortgage, and the fundamental concept of it, and again, they all work differently, but essentially it's a traditional mortgage, what we think of when we hear the word mortgage, but it's also got a line of credit which is attached to it. So you can think of it as these two sides to the mortgage. One is this $800,000 mortgage debt that we're trying to pay down over time. And the other side is this home equity line of credit, the HELOC. And the two sides speak to each other. So when I make a payment, as I do every month, I make my mortgage payment. A lot of that goes to interest to the bank, non-deductible. I see absolutely zero benefit of the $2,000, $3,000 each month that goes to the bank, the price I pay for borrowing their money. But some of it, maybe $1,000, does reduce what I owe on that mortgage. So instead of $800,000, I make my mortgage payment. Now I owe $799,000 on that mortgage.
Right.
Because the two sides of these mortgages speak to each other, the side that just went down by $1,000 leans over to the HELOC side and says, hey, I just got paid down $1,000. Oh, great, says the HELOC. I can increase my limit by $1,000. So whatever you pay down on this traditional mortgage, you're able to re-borrow on the HELOC. Now, what we do with that is very important, because if each month I've got access to $1,000, I can do something wise with it, or I can do something silly with it. And this is one of the main problems we Canadians are in such trouble on the consumer debt side of things, is because the banks have been selling these readvanceable mortgages for years, but they're not educating the homeowner on how to use this.
Right. So they'll spend it on renovations, a new car, a new boat, things like that.
You make a mortgage payment and then you see on your statement, oh, geez, what's this line of credit? I've got $1,000 I can borrow. Wow. Right? A lot of Canadians don't even know how it operates or why they have this line of credit.
Right.
I've got $1,000. How much is a BMW 5 Series each month? Right? Oh, I want a motorcycle. Honey, I'm taking you out to dinner.
Yeah.
I'm going on vacation. And so what's happening? Each month we're paying down very expensive non-deductible mortgage debt, this traditional mortgage, and yet we're re-borrowing very expensive non-deductible debt on the HELOC side, because we're borrowing to buy quote unquote assets which decline in value or disappear as soon as I buy that.
Yeah.
The car devalues right away. I borrow that money, I go eat, that food is gone. And so now, instead of $800,000 being reduced to zero over the course of 25 years, I end up 25 years later with $800,000 worth of debt because I've maxed out my HELOC, and it's all non-deductible, and all of the things that I bought with that are gone or rusting in my driveway.
Mm-hmm.
So what we do with that, when we have the ability to borrow that $1,000, we pull it out and we invest it. And the CRA, Canada Revenue Agency, says, if you borrow with the reasonable expectation of generating income, you can deduct the interest on that borrowing. So that means that in order to make it deductible, that borrowing each month of $1,000, I must invest. I can invest in stocks, bonds, mutual funds, ETFs, mix, REITs, investment real estate, any number of things which has a reasonable expectation of generating income. Therefore, once I buy that asset, I can deduct the interest on that.
Mm-hmm.
And guess what? I'm not buying cars, the consumer ends. I'm buying investment assets, which will appreciate in value over time.
Right.
And because I'm increasing my tax deductible debt on a monthly basis, I'm increasing my tax deductions naturally. So I work a 9 to 5. I send my tax return in at the end of the year or tax time. And the government says to me, the CRA says, oh, sorry, we took too much money from you every 2 weeks. Because they take a bit off your paycheck every 2 weeks. We took too much. You sent your tax return in. We didn't know you had all these tax deductions. We have to send you money back. Thank you very much, CRA. The only reason you're getting these tax refunds is because you're implementing this strategy, the Smith Manoeuvre. So take those tax refunds and make an extra payment against that mortgage. And guess what? Just like on a monthly basis where you're making a mortgage payment and reborrowing the principal that's being paid down, you can reborrow what you pay down on that with that tax refund,
Right.
and get that invested as well. So what we have happening is this wonderful cycle of I'm getting tax deductions, which reduce my tax bill. I love that. I'm getting my tax bill eased. I'm able to get rid of my expensive non-deductible mortgage debt faster. I love that too. And the only reason I'm getting these two benefits is because I'm investing for my future, whereas otherwise I wouldn't be able to.
Yeah.
Because all it is doing is using the regular mortgage payment that you're making anyways, whether you're doing the strategy or not.
Mm-hmm. I love that. A couple clarifying questions. So you talked about, in order for this HELOC to qualify as a deduction, it has to be something that has a reasonable expectation of making a return. Now, I love straw man arguments and stupid examples. So let's say I bought a Tesla and I financed it and I now drive for Uber. Is that, or does it need to be like through a registered account? Can I lend the money to a friend who's starting a business? Like what counts as something that, you want to clarify with an accountant if you're listening, but just broadly speaking.
Yeah. So broadly speaking, I've never come across an example where someone wants to invest in an Uber to generate income. I would imagine that someone, a tax professional who knows what they're doing, will be able to quite easily say yes or no.
Okay.
But the investment that we're talking about is, as it states in the CRA, they say you must have a reasonable expectation of generating income. And the key there is reasonable expectation. So I can buy, for example, an equity fund. There's no policy to send out dividends. There's no interest income coming from it.
Mm-hmm.
It's pretty much purely a capital gains play on my behalf, but I can still invest in that and deduct the interest on that borrowing because nowhere in the prospectus does it say we will never pay out dividends.
Got it.
So that's the reasonable expectation. Now, when we're talking about, and this is why it's so important to use someone who understands the strategy, the taxation, all that stuff, because I've seen a lot of people try to do this on their own. They blow themselves up because they didn't understand taxation. They didn't understand investing, mortgages, for example. But a lot of people will say, well, I'm going to pull my money out and I'm going to invest in gold bullion.
Sure.
Buy a gold bar, I'm going to stick it in my safe and I'm going to deduct the interest. Well, no, you're not, because there's no reasonable expectation of generating income from that gold bar.
Income. Increased value. Okay.
Correct.
Got it. Okay. If I buy, here's another stupid example. What if I want to buy a lakefront cabin and maybe I'll put it on Airbnb. Hopefully it's possible in the future, but is there a requirement for it to actually generate a return, or is it just a reasonable expectation? So if the CRA comes back to me, maybe not the cabin specifically, but if they say, Vince, you idiot, you didn't make any money off of this cabin, we're not going to honor this as a deduction. I guess that's just really between you and the CRA about what deductions are allowed.
Right.
Yeah. Okay.
And now, to be fair, I've never been an accountant. Complexities I cannot give a definitive answer.
Okay. Yeah.
And I expect that if you went and told the CRA, hey, I bought this lakefront property, I wanted to put renters in it and Airbnb, but no one signed up. I didn't, oh, well, did you go use it during the summer? Well, yeah, I went for a few weeks.
There we go.
There we go.
Yeah.
Right. So, this is precisely the reason that we've developed the Smith Manoeuvre Certified Professional Accreditation Program, which is a bit of a mouthful, but we've got now mortgage brokers, investment advisors, tax professionals, realtors, insurance brokers all across Canada who have gone through the course. They've got access to myself and the other people in the company. They've got access to each other with training and deal support, and they've got tools, so the Smith Man calculator, all of this, so that now Canadians can trust that they are talking to a professional who understands what they're doing. Because we heard so many times over the years from people, like someone would come into my office and say, when I was an advisor, and say, okay, you know what? The reason I'm here is because this investment advisor told me 6 years ago they were going to put me in a Smith Maneuver. I finally read your dad's book. I understand the Smith Maneuver now. What this guy has me doing, I have no idea what that is, because it's not the Smith Maneuver.
Gotcha. Okay.
Because just as much misunderstanding on strategy as there is in general public, there's also a great deal within the financial professional world, whether you're a broker, investment advisor, whatever your profession. So it is a dangerous thing to deal with people who play such an important role. You're talking about getting a mortgage. You're talking about investing. You're talking about dealing with a CRA. The last thing you want to do is use a professional who doesn't know what they're doing. And how do you, as a Canadian homeowner, know what they're doing?
Yeah, definitely. Right. Okay. So if someone was like starting today, do you have any should they have any expectations of, results that they can expect, starting this kind of mover?
Well, typically we're seeing, if we're talking about a $500,000-$600,000 mortgage with current rates and that sort of thing, 25-year AM, we're generally seeing net worth improvements of $300,000 to $400,000 at the end of the original amortization.
Wow.
And about 3 years off that non-deductible debt. So 22, 23 years instead of 25. And this is, again, only using the mortgage payment that they're making anyways.
Right.
That's the plain Jane Smith Maneuver. This is something that anybody with a mortgage, at least 80% equity, because they need a readvanceable mortgage, they can do this. The accelerators within the strategy see all these variables increase significantly, and a lot of Canadians have the ability to implement at least two of these accelerators, and everybody has the ability to implement at least one. And that will, again, further compress the amortization of that bad debt and increase your tax deductions, increase your net worth over time.
So at the end of it all, I know we're still going through the meat and potatoes of it, but at the end of it all, I'd paid off my mortgage. Now I have this massive line of credit for $600,000, just for argument's sake. So what's the conclusion of the Smith Maneuver? Do I keep this debt and just keep raking in the savings for as long as I'm earning an income that could benefit from deductions? And then as soon as I retire, I say, okay, now I cash out?
Yeah. The lovely thing about this strategy is that it's reversible. Mm-hmm. If you get into this strategy, you decide 5 or 6 later that it's not for you. What have you done? Well, you've already paid down faster that bad debt than you would have because of the annual tax change, but you still have that HELOC balance of deductible debt that you've built up. That is you have equity somewhere else. Mm-hmm. It's over here in the investments you purchased by that HELOC. So you can sell the investments and pay off that HELOC if you want, right? And go back to paying your mortgage off like everybody else does. But the first job of the homeowner when they're implementing the Smith Maneuver is to convert that bad debt to good debt. So let's say I'm able to implement a few of the accelerators. Instead of 25 years, that bad debt's gone in 10 years. It's being replaced with tax deductible debt. So that HELOC balance is now $600,000 with that example you want to use. What do I do now? Mission accomplished, debt fully converted. Do I decide that I am comfortable with having a $600,000 loan against my house going forward? Me, the decision is yes. Why? Because I'm paying, when we factor in tax deductibility, maybe I'm paying 2.5%, 3.5%, 4% if rates are really high because it's tax deductible. Meanwhile, I'm paying that 3.5% in interest. My investments are earning 7, 8, 10%.
Mhm.
So why would I want to sell some of those investments to pay off those debt? Financially, I wouldn't. That being said, not everybody is me.
Yeah.
But in 10 years, I've finished that first job with that mortgage. Now I decide, okay, you know what? That 600,000, I know it's doing good. My investments are doing good things for me. I just don't want it.
Mhm.
Fine. You can start to pay down that HELOC slowly, because don't forget, what you have to come out of pocket each month from year 10 onwards is quite likely less than what you'd be paying when you have that mortgage payment. Because even though the rate on the HELOC may be higher, there's no principal component to the payment.
Right.
So instead of $3,500 a month when I had that mortgage debt, now it's only $3,000 a month. Well, I was going to be paying $3,500 a month for 25 years anyways.
Mm-hmm.
So I'm going to continue to contribute that $3,500. I only need $3,000 to service the interest only on that HELOC. The other $500 I can continue to invest. Or I can use that difference, that $500, and pay down that debt $500 a month. Well, and that increases because the interest rate, is the balance right now. Or if that's not fast enough for me, I can sell $200,000 worth of my investment portfolio and pay down a big chunk. I can sell half my investment portfolio, almost all of it, pay off all of that deductible debt. But that's a decision I make once I've completed the first job of converting that debt from bad to good.
Okay.
That makes perfect sense.
Yeah. Love it.
Yeah.
Really quickly, Robinson, is there any sort of strategy for, would you recommend people start this right at the beginning of their mortgage journey? Or what about people who are listening that are 4 years into their mortgage? Do they, when their term expires, like converting over to this type of mortgage?
Yeah.
Do you have any sort of advice for those?
Yeah. Obviously, as you guys will understand, as many of the listeners will understand, the sooner you start investing, the better off you're going to be. So if you're a first time home buyer and you've got 20% down, get in touch with us. We can connect you with a Smith Manoeuvre certified professional mortgage broker, and they can say, okay, here's what, further educate you. And here's what the strategy looks like if maybe the right mortgage. If you're a first time home buyer or whatever the case may be, but you don't have 20% down, then you need to wait, because in order to get a readvanceable mortgage, you need at least 20% equity.
Right.
That being said, even if you don't have that 20% cash for down payment, you have to finance regularly, like a traditional mortgage. Down the road, people get pay raises. People get bonuses and payments, and they can get out of that mortgage that doesn't work for the strategy into one that does. If you currently own a home, you've had a mortgage for 4 years, 14 years, whatever the case may be, then it's worth looking at what does it look like to break my mortgage now, because it doesn't work, and get into one that does work. And many times, even though we've seen 3,000, 6,000 double-digit penalties to break a bad mortgage and get into a good mortgage, it makes sense. Because if I wait for 3 years when my renewal is up, only then to get into the right type of mortgage, I'm missing out on 3 years of investing. I'm missing out on 3 years of tax deduction accrual. Right?
Yeah.
So, but sometimes it doesn't. A year left, maybe it doesn't, depending on the rate score. Variation, right? So that's what I'll do. They'll look at your situation, say, nope, hold off. I'll contact you in a year and a half when you're up for renewal, or it makes sense. Here are the numbers. Do you want to go?
Mm-hmm.
Right. But whether you're buying your first home with 20% down, whether you are in a mortgage already, and a lot of people listening will have the right type of mortgage. They just don't know it.
Yeah.
Right. So that's why it's important to get an understanding of the strategy and reach out and get the advice of someone who understands what you have and what they can do with it.
Definitely.
Yeah. I'm just curious. Just on maybe this is something to talk to a mortgage professional that's in your professional network, but let's say you're 10 years into this plan. What if your mortgage, what the assessed value starts to go down? Then you're potentially, I guess it's no different than if you owed the money to the bank for a mortgage or to line of credit. But the advantage of the Smith Maneuver is you have this pot of gold.
You've got
not literally gold, but you know what I mean. You have this cushion. Yeah. So you have this cushion over there that you can kind of cash out and give you some flexibility. Okay.
Yeah.
Like it.
And face it, home values go down, markets up and down. The nice thing about this is on one hand, although it's a bit of a pain that you have to have 20% down to get the right type of mortgage, that 20% will act as a cushion, right? And like I said, this strategy has been continuous operation by Canadians for over 40 years now. And if it didn't work, in that period of time, we've seen rates up, down, the market's up, down,
Absolutely.
all of them, everything. We're seeing it all.
Yeah.
Almost. Hopefully. Right? But, it's a very robust strategy, and to back out of it, you get nervous because some people do, right? I started advising in 2006. We know what happened in 2008. Boom, off a cliff, the investment markets.
Yeah.
And people are people. And some of them said, I can't sleep, I need out. We punched them out. Those who stayed in, I thought it was March 2009 was when the market started to go back up.
Yeah.
You look at the markets now, and where they are now is much higher than the previous high before 2008, 2000.
We're on, I think, one of the longest bull runs in history right now, I think. All right. We seem to be doing pretty well.
Well, it's just, things keep on going up.
That's it.
TSX peaked today.
Yeah. So just enough time. And I think that's, further to your point about, okay, who is this not a good fit for? I think if you're trying to do this like a really short term, like this really, the compounding effect comes from the tax returns. And those really only happen once a year. Like you really want to be planning this for a bit of a longer term thing. This isn't like, oh yeah, I heard this great podcast. I'm going to refinance and do this for 6 weeks. And Robinson told me I'd make
Please don't contact us.
Yeah, that's right. Yeah.
It is a long-term strategy, and that's what I think believable once you understand how it works and why it works. Is that I'm not here saying, hey, give me 6 weeks and I'll make you a millionaire. Right? Mm-hmm. This takes dedication. It takes commitment, stick-to-itiveness, because on a monthly basis, just like you pay your credit card bill and make your mortgage payment, you got to move money around when you're engaged in this strategy. Mm-hmm. So there are things that you have to do on an ongoing basis for an extended period of time. But, this is very, very tired, but it's not timing the market, it's timing the market.
Yeah.
And that's
your favorite saying. All the time. Yeah.
Yeah.
Wow.
Oh, we heard from you.
That's right. Yeah.
I have one last question before we I want to move over to your work, the SMCP program. Mm-hmm. I would love if you have maybe an anecdotal story about maybe a family or somebody that throughout the course of helping people with this maneuver that maybe stood out to you as a success story that, it changed their life for the better or something like that.
There was a postal worker who was a client of mine. She didn't have a terribly large mortgage, but she had a number of years left on it, probably about 7 or 8 years. And she was done, I think, in about 3. And some of the quickest converting clients to have were realtors, because realtors tend to have investment real estate. And if you have investment real estate, guess what? You can implement the cash flow down accelerator. I'll talk about that now. But basically, we'd see our realtors with a few rental properties. They got 23 years on the mortgage when they come in. It's gone in less than 4 years. Basically what happens is I'm a Canadian. Let's say I'm into the mortgage, and because of my mortgage balance and the house value, I've got $100,000, $200,000 of immediately available equity, even before I started the strategy. One of the accelerators is prime to pump. So I can pull 50, 100, all that 200K out of the mortgage, and I buy my first investment property, let's say, in a proprietorship. We're not talking about in a corporation. I get renters. They pay me $3,000 a month. What most Canadians do is when they buy this rental property, they will open up a bank account, and every month the rental checks go into that account, and every month money goes out because I got to pay the mortgage on that rental property, maintenance, property taxes, all that sort of thing. So money comes in, money comes out. Hopefully we're a bit cash flow positive, but they're missing out on a very large opportunity here, because what we can do is, as we know, if this property is held in a proprietorship, that $3,000 I earn each month, I can do whatever I want with. I don't have to use that $3,000 to pay the expenses. So I take that $3,000, continue to make my mortgage payment on my principal residence, but I take that $3,000 and I make an extra payment against my mortgage, that non-deductible debt, against the house in which I live. Each month I'm paying down $3,000. And every time I pay down that extra $3,000, not only is the $1,000 opening up for my regular mortgage payment, but that $3,000 that I prepaid. I take that $3,000 out, then I put it into my rental account, and I make the payment on the expenses, my mortgage payment, property tax, etc.
So you're using debt to, like, from your HELOC to pay your fixed expenses.
I'm borrowing from that HELOC and making all the payments on my rental property. and I'm deducting the interest on that $3,000 that I'm borrowing to do so each and every month. Why? Because I'm borrowing to invest with the reasonable expectation of generating income. I'm investing in my rental property, which indeed is generating income, $3,000 a month. So now I got a mortgage payment I'm making each month, which drops the balance by, let's say, $1,000. I got a prepayment of $3,000 for my rental receipts. There's another $3,000. I'm pulling out $4,000. $1,000 goes into security, stocks, bonds, mutual funds. $3,000 goes out to service the expenses on that rental property. And if my expenses are only $2,500, I still pull that related $3,000, but I get to invest the difference. Only $2,500 goes to service the expenses on that business. $500 goes into growth, stocks, bonds, whatever it is.
Yeah.
Now you throw in 2 rental properties. You throw in 3 rental properties.
Yeah, my brain is hurting over here. This is crazy.
Smelling some.
Yeah. This is great.
Yeah. So, I mean, honestly, yeah, same thing. When I'm listening to all this, it's getting to a point in me right now where I'm finding it a little bit complex. So for me, I'm thinking like, obviously, like if this is something that, you have rental properties, I mean, both of us do, reaching out to, I guess, somebody who has taken your course and can kind of advise.
I'm like, I wish we could just cut and I'd ask you all these questions, but no, there are trusted adults we can talk to with these questions.
Yeah. Very cool. Okay. Yeah. Vince, do you have any follow-up questions on that one? Or?
I mean, how do I find these professionals?
Yeah.
What a layup question. It's just, I want to know, like, how do I connect with one of these people?
Well, we, on our website, smithman.ca, we've, of course, we've got a lot of information on the strategy for Canadian homeowners who want to learn more.
Yeah.
I'm selling my book on the website. If you don't want to invest the money to buy the book, but you're interested in learning more, go get the book from the library, right? Mm-hmm. But that's the first step is learn more. Buy the book, please. If you don't want to, get it from the library for free. On that website, we have 2 tabs as well. One is find a Smith Manoeuvre certified professional, and then you click that and answer some questions. Who are you? Where are you? What's your email? All that stuff. And then we connect you with someone who can help. We also have a tab, become a Smith Manoeuvre certified professional. That's for mortgage brokers, investment advisors, accountants, realtors, insurance brokers who want to take the course, become an expert in strategy so they can help their client base implement Smith Manoeuvre.
Just a quick side note on that. We do have, as our audience, a lot of people that are real estate professionals. Not a lot of real estate nerds just want to listen to a real estate podcast all the time. A lot of them are actually like professionals in a space. So this sounds like it actually would be a really good program for them to look into. I'm curious, like what's the best way? Like they'll just reach out through this tab on your website. And I wonder, just thinking out loud, we just had amongst realtors in British Columbia, we now have a requirement for additional professional development hours. So that number has just gone up to, I think, 21 hours every 2 years or something like that. So I wonder if this training program might even
qualify for CE credit.
Yeah.
At this point, no. I was business network out all wealth until May, I think it was, when I decided it's time to build a company and stock it with people who can run operations, can run marketing, can do the admin. And so we've relaunched with a whole bunch of new ones for our membership. One of the things that I've been noodling for a long time is will this course, can we get this course to be accredited, if you will, by the investment industry, by the real estate industry, the mortgage industry, so that it does count for CE credits. And so that is something that we will be looking at in the future. But as everybody knows, when you birth a business, there's
Yeah. Well, then I think those 3 from 18 to 21 are
self-directed. Okay, so this could count. Okay, awesome.
Awesome.
I'm just curious about this program. How many hours would you say it takes if I want to sign up today?
So, the exam is, I don't know, the 100 questions, multiple choice.
100 questions? They're stressing me out.
But people who enroll in this, we send them a copy of my book, and we send them to something on the internet. There's the course manual, and we've had people complete the course in a week. Shutting the office door, don't bother me, just knock when my dinner's ready. And put it by the door. Some people a couple months because family and kids and that sort of thing. But it could be done relatively quickly. And at that point, once you pass the tests, you are an SMCP, and then you're in with all the other SMCPs located in the country, and we're throwing back, sort of questions back and forth in our training support, and we have,
Nice.
so that's deal support, and we have training. I just today gave a training on the Smith Manoeuvre calculator. We developed a calculator which you plug in your income, your assets, liabilities, house value, all the mortgage information. Do you want a rental property? All this stuff. And the SMCP, who has exclusive access to this, will, calculate what the projections are for any given homeowner based on their personal situation.
Right. So it sounds also, just to plug it for the professionals that are listening, it actually sounds like an interesting networking tool as well, because you're going to be potentially connecting and working with people across Canada.
Well, that's when I was an advisor, it was my dad and myself, two advisors. We had a mortgage broker who lived in our office, if you will.
Nice.
And we had an accountant here where you folks are based. And we would just send clients around to each other. And we didn't do any marketing. We'd sign up a cop. And then he goes and sits in his cruiser for 8 hours a day, 10 hours a day, talking to his partner. Heard about the Smith Manoeuvre? When they're not fighting crime, you drive around.
Yeah.
And you get 8 cops. You sign up a pilot. They sit in cockpit and talk all day. You sign up a whole bunch of pilots. Stewardesses, military, government workers, union members.
Yeah.
But then the nice thing is that you get these clients, and let's say a mortgage broker, and it looks like you got $150,000 of immediately available credit the day that we push the button on your new mortgage, so you can do a strategy. What do you want to do with it? Well, a mortgage broker is going to say, you can take some of that and buy investment property. I'll help you finance that too. And sounds good. Great. I've got an SMCP realtor. I'll put you in touch with them.
Wow.
Yeah.
And the realtor will have a client and they're interested in it. Well, I got to send them to a mortgage broker to get the financing. And so the tax professionals, they all just send clients around to each other, which is extremely comforting for the client because they know for certain that their mortgage broker, their investment advisor, their accountant, their realtor, they know that all these professionals know each other and know exactly what that client is trying to achieve in their personal financial situation.
Mm-hmm. Yeah.
And
we're all using the same playbook.
Yeah.
That makes sense.
And what was the website again, Ramsey?
smithman.ca, smithman.ca.
And we'll put that into the show notes as well for anyone that wants to click the link and check it out. Definitely. Awesome. Perfect. Do you have time for some fun close up, or is there anything else you want to chat about before we kind of...
Actually, one of the questions that I usually get, which you guys didn't ask,
yes,
is it legal?
I assume.
And it follows on the remark you made earlier, too good to be true. Is this legal, right? Yeah. If it were not legal, there would not be 2 best-selling books written on the subject. It's been around, as we were talking about earlier, for 40 years. There's a network of professionals. My clients, I had judges, police officers, lawyers. I even had CRA employees as clients. This story that, speaking of the CRA, that my father used to like to tell was, his office is in Sandwich. He was at his office and one day his assistant opens the door and says, Fraser, there's 2 men in suits who are here to see you. They don't have an appointment. And it turns out they were from the CRA. Dad's like, get them in here, right? We're here to talk to you about this Smith Manoeuvre thing that you're doing. And so back then there were models and computer stuff. So Dad just out a yellow legal pad and wrote down and drew pictures and said, this is how it works. And this money flow is this way. And this is why CRA has no problem with it. Reasonable expectation. And Dad used to love to tell the story. He says, halfway through, the little guy leans forward and says, would I be able to do this all mornings?
Awesome.
So, and they left and Dad never heard from it again, which is most you're going to expect from the CRA, right? So, yeah, it's essentially written in the tax code that is a legal strategy.
That's fantastic.
Yeah.
Wow.
Yeah, I'm excited to learn a bit more about the rental. Yeah, definitely. Awesome. Yeah, cool, fun questions.
I'm not a very fun guy, but I'll give it a shot.
You try.
Do you have a book, podcast, or resource that you recommend than your own?
Well, best podcast I know is on the side. A lot of people expect an answer to like, mind focused or wealth creation, that sort of thing. But I always talk about Zen in the Art of Motorcycle Maintenance by Per Se. I don't know if you guys have read it, but it's a book about, real briefly, about perfection, basically, or the pursuit of perfection, and that everything you do, no matter how small it is, if you do it with perfection in mind, then boom, things just explode.
I like that. Other side of things, do you have a guilty pleasure TV show, music, or activity outside of finance that you're kind of into right now?
You mentioned TV show.
Yeah.
My wife has gotten me into Nashville.
Nashville, okay.
So you can edit this out. Yeah, so currently we're learning the guitar.
Oh, very cool. Awesome. If you could own any property in Canada for free, where would it be and why?
Oh, well, we already live on the West Coast.
I know.
Where do you go from here? Really?
Where do you go from here?
Yeah.
In Canada, I'd probably say the East Coast. I ride a motorcycle, and I hear there's great roads out there, and that's I haven't spent a lot of time with.
Yeah. Cool.
Nice.
And then the last question I have is, what is one purchase you have made in the last year under $1,500?
This is probably my favorite question on the show.
that has changed your life. And then it could be the most recent years. If you can't think of anything more recent.
Under $1,500.
Yeah.
I think my little guitar that I polished off.
Oh, I
went to Victoria. Yeah, maybe a month and a half ago, $200.
And then you've been taking lessons, or how are you learning?
No, I'm a typical male. I've been teaching myself.
Yeah, I figure that out. How hard can it be?
That's right.
How many strings are on this thing?
I think the lessons will come to road. But for the moment, I'm learning how to pick and strum. A couple songs on my belt.
Nice. I love that. We'll have you on next time, and you can, show us a couple.
You could do your show music. Like,
yeah. Awesome. Well, Rob, thank you for coming on today. For anyone that would like to learn more about you or what you're doing to connect with you, what is the best way to do so? Would it be the website?
Yeah, smithman.ca.
Okay. Awesome. Again, big thanks to Rob for an amazing conversation. And that's a wrap. Make sure to follow us at the Victoria Real Estate Podcast on Instagram for more behind the scenes new listings and local real estate tips. Thanks for listening to Victoria Real Estate Podcast, produced by the City Nest team. We've had some fantastic reviews and we love them. So please leave us a review on Spotify, Apple Music, or wherever you're listening. We also really appreciate you guys sharing the podcast with friends and family. Otherwise, Vince, how can people get in touch?
Send me an email, vincent@citynest.ca. Thanks.
And reach out to me, Adrian, at 250-464-4122 or on Instagram at Adrian Real Estate Victoria. Thanks.